Hey guys, hope you're doing well out there. Today bringing you a slightly different video. Wanted to do a deep dive into Tesla and their numbers. Wanted to take a look at some news over at Tesla, take a look at its valuation and determine my fair value for this stock over the upcoming 5 years. And as always, jump into the technicals for Tesla to see whether this one is trading at an attractive price today or not. As always, if you are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button. Your support would mean a lot. Tesla trading right at $265 per share. I'm recording this during the trade, so you'll see this one jump around a little bit. Over the past year to date, Tesla has participated in the tech sector rally, up in just 145%. This one's market cap has now ballooned over $800 billion. And there's a good reason for that. Musk and Tesla are the clear winners of the Detroit auto strike. Analyst says Elon put champagne on ice as he sees the ultimate victory falling in Tesla's hands. And so Detroit's big three automakers, Ford, GM, and Stellantis, are facing some troubles from their auto workers as they have gone on strike. I believe last Friday is when the UAW auto workers strike began. And really the clear winner from all of this is Tesla. And as Tesla sits in a non-union position and therefore isn't at a risk of a strike from their workers. And ultimately, Detroit and their competitors are now facing mounting costs in the years ahead, and we'll see ultimately how this plays out. But essentially, the UAW are demanding for a roughly 40% pay hike in order to make up for years of inflation. And ultimately, that is going to be harder for them to compete with Tesla on prices, especially when they're already paying a significantly higher labor-related cost compared to Tesla. Another 40% pay hike on that will certainly help Tesla out in terms of gaining market share. And ultimately what this does is hurt the US auto industry, where now a lot of manufacturing will be outsourced outside of the US, where frankly it is far cheaper to manufacture. Tesla plans to build a new factory, and it's no surprise there's a lot of countries that want to host that. And so Tesla is planning to build another gigafactory someplace. That would be their 8th gigafactory. And the president of Turkey had a special request for Elon Musk and would like to see Tesla's next factory built in the country of Turkey. Musk did say in May that Tesla would probably choose a site for their next gigafactory by the end of this year. So we'll wait on that announcement. In August, he did mention India as a possible place for their next gigafactory. They're currently building their 7th gigafactory down in Mexico, and that, I believe, is slated to be completed sometime next year. Now, recent talks are also coming out of Saudi Arabia that they are in talks of setting up manufacturing there, as Saudi Arabia is looking to diversify its economy away from oil and aiming to secure heavy metals needed in the production of EVs. So we'll see where Tesla's next gigafactory does come out to be, and certainly we know that wherever it goes, it creates a lot of jobs and helps stimulate the economy. So it's no surprise a lot of countries are bidding for that. Tesla's price cuts might not be over, and that's a bad news for margins, says a Goldman Sachs analyst. So a little bit more on the bearish side. This Goldman Sachs analyst is seeing price cuts for its Model S and Model X vehicles, that taking a toll on Tesla's margins and their ASPs, or average selling prices. Now, their increases in the price for the Model 3 will only be partially offsetting this lower prices on their high-end vehicles, and they also believe Tesla could further lower prices in 2024 in order to support higher volumes, and that will reduce their EPS both for this year and the upcoming 2024. So this analyst sees EPS for this year coming at $2.90 and EPS for next year coming in at $4.15. Taking a look at the general consensus estimate over at Wall Street, EPS for this year is much higher at close to $3.50, and for next year it's close to $4.91. And so certainly this analyst has cut down their EPS targets based on these price cuts that we're seeing out of Tesla. And we know this year they are expected to slow down in their EPS growth and really contract even. We see 15% contraction in their EPS on a year-over-year basis. That's largely due to this high inflationary environment. Tesla has had to cut back on their prices in order to continue to meet demand. We know Wall Street estimates are for 1.8 million deliveries this year. They delivered close to 1.2 million vehicles last year, and deliveries for upcoming 2024 are expected to be roughly 2.3 million vehicles. And so certainly if Tesla wants to meet these numbers of deliveries, yeah, those price cuts will have to go in effect, and that ultimately will affect their gross margins and EPS, at least in the short term. Now, on the other spectrum, we see Ron Barron seeing Tesla could hit a $4 trillion valuation by 2030. That would represent a 4 to 5x between now and 2030. That's what Ron Barron sees. He is a huge backer of Tesla and has been for a long time. In the next 7 years, he sees Tesla being 4 or 5 times as big as it is right now, and a $4 trillion valuation would mean a 5x from its current levels of close to $270 per share. So certainly Ron Barron is quite bullish on Tesla and has been for a long time. We'll see just how he sees numbers playing out, and we'll take a look into our fair value for Tesla. Taking a look at Tesla's forward valuations, so certainly on any traditional metric, even forward valuations, this company certainly is not trading cheap. In terms of a forward price to earnings, it is trading close to 76 times. We see over on Seeking Alpha, we see the sector median is closer to 14. Now, that's likely because Tesla is being compared to companies like a GM, like a Honda, like a Toyota. And while certainly they are automakers, there is a reason Tesla has to be trading more expensive. And I would say that's largely due to 2 reasons, those being higher gross margins and higher growth rates. So certainly if you were to take a look at the gross margins and growth rates at any of these other automakers, they're certainly nowhere near Tesla's. And so that deserves a premium in the stock market, which Tesla is receiving. Now, certainly 76 times forward earnings, I think, is still too expensive, and we'll see if that can come down in the subsequent years. On a price to sales, this is trading close to 8.4 times price to sales basis. That's on a forward basis, trading closer to 9 times price to sales on a trailing 12 months. Price to free cash flow, this one is close to 58 times, and an EV to EBITDA multiple of close to 46. So certainly the forward valuations of Tesla either have to come down, or Tesla needs to grow into those multiples in order for that to make sense. Now, in terms of their balance sheet, Tesla is positioned quite well in terms of their balance sheet, as they have a cash to debt ratio of close to 4 times. So certainly they have a lot more cash than debt on their balance sheet. We can come down here. Total cash sitting at close to $23 billion compared to a total debt value close to $5.8 billion. We know even their current ratio is over 1, which is nice to see, as they have more assets than liabilities. Over the past few years, Elon Musk has been the guy in order to raise cash over at Tesla, and certainly if there's one person you want raising equity and cash for your company, there's no one that can do it better than Elon Musk. And so that has put their balance sheet in a very strong position, and that has allowed them to invest in gigafactories and speed up their manufacturing that will ultimately bring down costs over the long run. Now, taking a look at their 5-year historic CAGR on that revenue side, Tesla has been growing at close to a 50% clip year over year for the last 5 years on their revenues. Coming over to Seeking Alpha, we see back in 2018, they were doing revenues close to $21.5 billion. That has grown all the way up to $100 billion expected this year. And so over the last 5 years, that represents a 5x. And certainly that compounded annually is close to 50%. Now, next year, they're expected to do $128 billion of revenue. So that growth is expected to continue. Year over year growth next year is expected to be 28%. And then the following year, close to 24%. And so certainly on their top line, they have been growing quite nicely. Certainly not at 50% over the upcoming years, but that is the law of large numbers. As you get bigger, revenue growth will come down, but still remains quite strong, especially compared to other automakers. Now, EPS growth over the last 5 years is non-meaningful because back in 2018 and 2019, Tesla was not actually profitable. They recently became profitable over the past 3 years. However, since then, profitability has been on a steady increase. Apart from this year, as we know, there have been a lot of price cuts to their vehicles, and currently Tesla is making the majority of their revenues from vehicles. I know there's a lot of talk on the Dojo supercomputer and full self-driving and software and charging. However, as it stands right now, Tesla does make the majority of their revenue through vehicle sales, and that's all their revenue depends on. And so certainly if their vehicle's ASP or average selling price is coming down, that's going to affect their bottom line margins. We see next year EPS is again expected to resume back on that strong growth, close to 50%, and so certainly we'll keep an eye on that, and EPS trending in the right direction over at Tesla. So while over the last 5 years they don't have a historic CAGR, EPS is expected to grow in that high double digits range over the upcoming years. Now, coming over to our estimates, and in order to determine our fair value, we have to predict what we see Tesla doing in this upcoming 2024 fiscal year, and so that will ultimately depend on the estimates we make, and that will affect our fair value. Now, we see analysts over at Wall Street are expecting Tesla to do close to $4.91 per share of EPS in 2024. That would represent 42% growth on that year-over-year side. Now, moving over to net income, this is based on our EPS multiplied by our shares outstanding. So taking a look at Tesla's shares outstanding over the last really 13 years, we can see back in 2020 they had roughly 3.25 billion shares outstanding. Now in this most recent quarter there were close to 3.48 billion shares outstanding, and so you see every year they've been diluting shareholders by increasing their share count. Now over the past few quarters that has come down substantially. As you see in that last quarter they diluted shares by just 0.5%, and so I'll take shares at close to 3.478 billion outstanding, and so entering 3.478 billion shares outstanding, we come to a net income number of close to $17 billion. That's based on the assumption Tesla does not dilute shares in these upcoming Q3 and Q4. Now, taking a look at our 5-year future estimate for EPS growth, I'll take that to be 25% and apply a 25 times price to earnings multiple, bringing our PEG ratio close to or exactly at 1. And so I'm taking that 25% CAGR on that bottom line, as I don't think Tesla will be able to grow their bottom line at close to 40% for the next 5 years compounded, but I do see them doing close to 25% on that EPS side over the next 5 years, and then applying a 25 times multiple brings our price to expected growth multiple at exactly 1. I'll take share dilution over these next 5 years to be 0% each year, as I don't think Tesla will be diluting shares as fast as it has in these past 5 years. Certainly there is a case that they could maybe start doing a buyback, but I also don't want to price that in, and so I'll take a 0% dilution rate, applying a 12% discount, because that's what we want the stock to return every year over the next 5 years, and taking a 10% margin of safety, we come to a fair value of close to $191 per share. Currently the stock is closer to 263, and so that represents Tesla stock needs to come down roughly 27% in order to come down to our fair value. Now certainly if you think EPS numbers will not be as high as $4.91, certainly some analysts see EPS being closer to $4.50, our net income comes down closer to $15.6 billion. Keeping everything the same, our fair value also comes down closer to $175 per share. Now on the flip side, if you do see Tesla doing EPS numbers of close to $4.91, and maybe you see a 30% compounded annual growth rate on that bottom line and applying a 30 times forward price to earnings, we get a fair value closer to $279. And so in that case, you can see Tesla can be trading at a discount today to its fair value. So it all depends on essentially how aggressive you are in your estimates. I would prefer to be more conservative, and so see Tesla doing 25% CAGR on that EPS side and applying a 25 times price to earnings multiple, bringing my fair value closer to $191 per share. Now in the news story we covered, we know Ron Barron is expecting Tesla to be close to a $4 trillion valuation by 2030, and let's just run some numbers on I guess how he sees Tesla really getting there. And taking an average selling price I took to be 50,000. Now currently Tesla, I believe their average selling prices are close to 58,000, somewhere around 57,500. However, I took ASP to be lower at 50,000, as certainly Tesla increases production, their prices will come down, and so their ASP certainly won't be as high as it is today. Now, Ron Barron also has a prediction that he sees Tesla doing close to 20 million deliveries every year in the year 2030. Certainly, Tesla is expected to deliver 1.8 million vehicles this year and 2.3 million vehicles next year. And so getting that number up to 20 million in just 7 years seems a bit ridiculous in my opinion, but this is Ron Barron's estimate, and so he sees deliveries reaching to $20 billion by 2030. And so that would bring our vehicle revenue to be close to $1 trillion. You take 20 million deliveries, multiply that by an ASP of $50,000, and there you go, your revenue is at $1 trillion. Now, certainly that's hard to imagine, but keep this in mind. This is for the year 2030, based on 20 million vehicles delivered with an ASP of 50,000. And this is just vehicle revenue. There's no charging, there's no software, there's no solar, there's no full self-driving, there's no dojo included in this revenue. This is just purely for delivering EVs. And so with a $1 trillion revenue number, if we take an 18% net income margin, that would bring our net income close to $180 billion in the year 2030. And then taking that net income and applying a forward PE of 20, we get a market cap of $3.6 trillion. And so there you have it, close to a $4 trillion market cap in the year 2030, based on 20 million vehicles delivered and an ASP of 50,000. Certainly this stock is close to a $900 billion valuation today. And so there, that would represent your 4 to 5x on Tesla stock, just purely based on vehicles delivered. Again, this is not taking into account any of their other business segments that right now, although are small, I'm sure by the year 2030, software will be a big portion of Tesla. One analogy I like to compare it to is Amazon. If you take a look at Amazon 10, even 20 years ago, the majority of their revenue was coming from Amazon.com and their e-commerce business. At that time, AWS and especially advertising were not even on the horizon. However, what's happened now over these past few years is that AWS and advertising has been their growth engine and really been their profitability engine. And so maybe that is what we should expect from a Tesla, where sure, they are delivering their vehicles right now, and that's where the majority of the revenue is coming from. However, down the road, maybe in 5 to 10 years, the majority of their growth and margins will be coming from software services. So think Dojo supercomputer if they make advances on AI, or through full self-driving, possibly the robotaxi network, stuff like that, rather than the actual selling of their cars. Now, with this prediction of Ron Barron, certainly I think this is absolutely ridiculous. I do not see Tesla doing 20 million deliveries at all in the year 2030. If anything, I see them doing 5 million deliveries in 2030. And so even considering them doing 5 million vehicles with an ASP of 50,000, that would bring our revenue close to 250 billion. Applying the same 18% net income margin, that would bring our net income close to 45 billion. And then with a 20 times price to earnings multiple, that gives us a market cap of close to $900 billion. So that's certainly where Tesla is trading today, close to $900 billion. However, this is for the year 2030. Now, again, this is only for the cars delivered. And so certainly if you add on a solar business, a charging business, benefits from full self-driving, possibly the Dojo supercomputer, things like that will help your market cap and ultimately will probably help your multiple be higher than just 20 times, especially if they're moving more into software. So consider Apple these days is trading at a higher multiple than it used to back in the days where it was essentially just a hardware company. That's because Apple has grown into becoming a software and services business, and so deserves that higher multiple. If Tesla can do a similar thing, transition more into software services, yeah, it can see multiple expansion from this 20 times price to earnings. And so I do see Tesla being close to a $2 billion market cap in the year 2030, which would still represent over a 2x from today's prices. However, close to $4 to $5 trillion, that is a bit outsized in my opinion. Moving on to the technicals over at Tesla, you see this one has been locked in an uptrend since really the end of last year. From its lows close to $100, this one has rallied over 150%. Now it is making clear set of higher highs and higher lows. You see it made a low back in January and then a subsequent higher low in May and a higher low over in August. Now it certainly hasn't made a higher high from its July highs of close to $290 per share, but I would still consider this uptrend to be intact. Now they are expected to report earnings on roughly October 18th, which would be roughly a month from today. And so if Tesla can maybe even trade sideways until then, until we see delivery numbers perhaps for the September month, that would be a good sign in my opinion. If it does come down and backtest this range, I wouldn't panic at that point. Certainly it has the ability to bounce off this level. Now if it does come down and breach this uptrending trend line, in that case I think at least the past 1 year uptrend for Tesla would be broken. However, I do see a strong level of support for Tesla. I want to say close to $210 per share. This is a place where there has been a lot of support for Tesla shares closer to this $210 range. Certainly if it breaches this $210 range, I would be interested in picking up shares of Tesla. Really anywhere below 200 is where I think this one makes a lot of sense, especially my fair value would start making sense at closer to $190 per share. Now in terms of a level of resistance, I think Tesla can hit its head closer to this $285 per share. Breaking out over these previous set of highs is really what we need to see from Tesla in order for it to run up over $300 per share. Now certainly I would wait before jumping into Tesla. Full disclosure, Tesla is a big position in my portfolio and I would be looking to dollar cost average anywhere below 200. Now certainly if you don't have any shares of Tesla, this $235, close to $230 per share level of support could be a good place to maybe step in and buy one share. If you're looking for a 10 share allocation, this is certainly a place where you can maybe step in and pick up one share, and then subsequently if it heads lower, pick up shares closer to this $200 support. That was a look at Tesla, certainly facing a few headwinds in the near term, especially relating to their price cuts and EPS profitability numbers. Those are expected to decline. But I am a believer in Tesla for the long term. At its current level, I don't think Tesla makes the most sense from a risk-reward basis. However, for a long-term perspective, I do still think Tesla is a phenomenal company. Let me know your thoughts on Tesla and what your fair value for this company is over these next 5 years. As always, thanks so much for listening, and I'll catch you guys in the next video.